Hey everybody, it's Craig Moser. It is the 7th day of January already, 2022. Hope you guys are healthy. Hope you have had a great holiday period of time, and we're all ready to get moving here a little bit. So a little different view today of some of the charting stuff that I usually provide for you. So I'm only looking at a chart of 3 months. So we're looking back in time 90 days, saying how are various markets doing, and sort of getting our minds lined up for what could happen moving forward. Now, I'm going to do a educational piece next month, and it'll be if you use a crystal ball, sometimes you might eat broken glass or ground glass. I'm not sure exactly what we'll call it yet, but we're trying to come up with a interesting title on that. But it will be talking about predictions and how often those are correct. It'll be fascinating, and then we'll dovetail that into some investment strategies in case you have questions or want to take a portion of your dollars and move them either into a less aggressive profile or a more potentially advantageous profile, meaning that you're willing to take a little more risk to perhaps make a little more return. Okay, in no particular order today, I happen to have up on my screen here the emerging markets index. iShares does this one, but Vanguard has one, S&P has one. There's a lot of these indexes out here. They're just looking at, your China, Russia, India, and the emerging market type countries and the stocks inside of those as an aggregate. So if we look back over 90 days, what you're seeing here is we had a market spike. Last real high in the last 90 days was October the 20th of last year. And it was, it peaked there, and it dropped as much as 10%. And now it's down from that point about 7.5, somewhere in that range. But the point is, we're not making higher highs right now. So some of this is probably portfolio managers repositioning their portfolios after the first of the year, trying to get things squared up, didn't want to create a big tax event last year. Some of it is just moving things around. But up here is your average price. So obviously, as we're looking at the last 90 days, emerging markets would not be something that we would really want to add into an account or portfolio at this moment. Nothing terrible happening, it's just not in an uptrend. As we look through, we'll look at Europe, Australia, and the Far East as an index. So again, we're looking at Great Britain, Germany, France. We're looking at Canada, Australia. We're looking at countries other than the United States and looking for some sort of market direction from them. And over the last 90 days, we really haven't seen much. We're bouncing all over the place. So this particular index, these countries capped out around the 8th of November, similar to the other one, had a pretty substantial decline, and now they're trying to find a direction. Unlike emerging markets, though, Europe, Australia, and the Far East is closer to their average price, their 200-day moving average. So as we're looking at countries outside of the United States, not so hot. I mean, not terrible, but not so hot. If we look at the S&P 500 as our example, here's the S&P. So had a market cap here. We had a decline of about 4, had another one, a decline of a little over 4, and now we're up over in this range. And then yesterday, or let me make sure of the date, the 5th, not yesterday, we had a pretty big decline. So the market's trying to find its way. Guys, understand this single asset class, which would be defined as large U.S. company stocks, not foreign, just the large U.S., has been really the bellwether for quite some time. So when you're looking at your portfolios, it's easy to slide into a single asset class and say, oh, well, this one's been a real winner. Let's stay with that one. Whereas you may end up in a situation to where you're buying last year's winner, which might be this year's not winner. I don't want to say loser because these are great companies, but every asset class has been the top of the scale at some point in the past. So understand, nobody stays on top forever. So S&P, again, probably the same things that I mentioned in the other ones. We're having, some sell-offs, people taking some profits, and we're seeing more and more volatility. So down on the bottom, these these vertical bars here, those are daily volumes. So you can see a big spike in sales. Red is sales, and green is buys. So over the recent past, there's been a lot of selling activity in the S&P 500. That's either good or bad. We'll see what happens. But I wanted you to look back only 90 days. It's tough for me to do that. I want to go back and look 1 year and 2 years. But I thought it might be an interesting look to say what has happened over the recent past. Because it's easy to think, oh, everything's great. We're starting to see more volatility. We're starting to see more sell volume. And it's fairly, when we have it, it's getting to be a little bit higher. All right, so let's look at something else. Let's look at gold. Gold, yeah, sort of the same thing. We're sort of in a sideways churn. We get buys, we get sells, we get sells. You can see that from its last market top, which was mid-November, we're down about 4-ish%, somewhere in that range. So not making highs, but it's like everything else, moving all over the place if you're looking at a very short window of time, which in my case is 90 days. Bonds. So, when we see my friends that do asset allocation and they use the strategic investment strategies, they're saying that the risk mitigation tool that they would use primarily would be bonds. The more conservative you are, the more they use fixed income as their choice. That's neither bad nor good. That's an approach. There's several approaches to investing. But when we look at bonds, if interest rates begin to increase, the price of bonds begins to decline because you already have existing bonds that have been issued. And what you're seeing happening is, if you have something that's a 1.5 or 2% bond and they raise rates just in theory to 3%, nobody's going to pay you full price for your bond. So that's at least what we're seeing as far as expectations. So again, 90 days back, we had a short-term top mid to early November. And since then, the bond prices have been in a slight decline. This isn't a huge loss, but on bonds that only pay 1.79% over the course of a year, right here, a 2.48% decline in the price kind of negates what you'll make for the whole year on interest. Strange world we're in, right? All right, so let's take a look at what else might we look at here. We've looked at all the major asset classes. Small cap. I hear, what about, should I do something like small cap? And sure, we can take a look at small cap value. No real direction there, but maybe a little short-term strength over the last 5 to 7 days. Let's see if we can do another. I always forget these symbols. Here is just the small cap core. Looks about the same as the other one. But again, we're seeing a lot of short-term volatility. Probably some of this is repositioning for portfolios. And if you're reading some of the research, they're saying you may not see the same types of returns this year or going forward that we saw in the previous 2 years, because there's probably not going to be as much money print or government stimulus going into the economic cycle. Mid caps, let's see if I can remember these symbols. Is that it? So that's mid cap growth, big decline there 2 days ago. So again, we're flopping around. Nothing to be alarmed about, but understand over the last 90 days, there really hasn't been any direction in stocks, in bonds, in gold. So this volatility might be something that in 2022, we might need to learn how to navigate through as we are investors. Anyhow, that's all I have to really say today. If you have questions, as always, feel free to give us a call here. We'll get you set up to chat if you want to do that. Our number is 336-448-1086. You can find us at maestrowealthadvisors.com. Happy to have you sign up for newsletters or get any information. And over the course of this year, one of our goals is to provide you with ongoing education. So we'll be doing two types of education that you can plug in. One of them is if you want to know how different investment things work, we'll be doing what we call 101s. 101s will be what's a mutual fund and how does it work and why would I own it or not own it? You know, how does a stock actually work and why would it distribute money to us? How could I make money? How could I lose money? Other different ways that works. And we'll also be doing some advanced planning type things, which we'll talk about concepts, you know, things like Roth conversions. Why would I do it? How would I think about approaching it? Things like that to try to help you make good financial decisions and get as educated as you can be. So I hope that's going to be something that you'll enjoy as we go through this year. I look forward to doing them. And with that, I'll bid you a good January.